So I'm Equi again. In the past, I started my career at UBS, went on and funded a wealth advisory group as well as a hedge fund. I have fairly good amount of experience in alternatives, and I'm just super excited to be here, a part of Equilibrium. Essentially, bringing
don't give it all away, because we're going to get to it in a second. Okay.
I won't give it all away, but I'm very, very excited to be a part of Equilibrium.
Great. Wonderful. All right, Itai, you now have the ability to share your screen. Everybody's got the context. Do you want to take it from here?
Yeah, absolutely. So let's just hop into it. I'm going to share my screen very quickly. So give me a sec. It's not loading up. There you go. Got it. Can you all see the screen?
Yes, we can, Itai. Thank you.
Cool. I will share it on. So welcome to Equilibrium University, April 19th, 2021. We are Equilibrium. Jeremy will tell you what we do.
Okay, no, we're not going to do that. We're going to launch another poll. So everybody, we're going to take 40 seconds real quick, and I'm going to ask you all, what does Equilibrium do? It is a multiple choice question. Some of you have met us before, some of you haven't. So it is your chance to take a guess at what we do. Somebody's thinking we do interactive Zoom calls. They are for sure right about that. A lot of people are saying we do all of the above. Paul Verano feels very strongly that we are doing all of the above. And you guys, we've probably got about, I don't know, about 10 more seconds in this. Oh boy, Itai, they figured it out.
Uh-oh.
In the end, like all great poll questions, the answer is always all of the above. Can you tell everybody a little bit about just what Equilibrium does in maybe 30 seconds, and then we'll hop into the actual presentation?
Yeah, for sure. So we are a fintech company that we're basically giving you, for the first time, access to a very diversified managed solution of alternative that is at a much, much lower AUM level, or basically investment level, than you would provide in the past. So anything from real estate to private credit to hedge funds to volatility, all with click of a button in one portfolio in one easy place.
Itai, you couldn't have said it any better. Thank you. All right, you want to hop into it?
Let's hop into today's content. So the stock market has been roaring for anybody who's been living under a rock, and has done extremely well in the past year. So how well? When we look at the level of returns compared to, so this is not the classic, like this is how much percent the market has gone up. This is a year-over-year percentage change. So think of it this way: if the market's done 10% in one year and has done 20% the following year, the year-over-year rate of change is essentially 100%, right? So the market's year-over-year rate of change has only been at these levels essentially 5 times over the past 100 years. So things have been pretty good. And why have they been so good? As we've explored it many, many times, the balance sheets of the central banks have expanded quite a bit. This is a look at all the big 4 central banks. So the usual suspects, the European Central Bank, the Fed, the Bank of England, the Bank of Japan, and how much they have actually printed, or I would say used quantitative easing over that past decade. So we are here in 2021, and the projection is for some kind of tapering into 2022, but it will still be far and above the levels of QE used in the past.
Right.
And here is an illustration of a year purchases by those big 4. 2020 was absolutely stunning with $5 trillion of purchases. Makes 2008 look like a much smaller intervention. And then 2021 is going to be tapered somewhat. And then 2022 will go back to the levels we were used to seeing in 2013 and onwards. So of course, all that increase in quantitative easing can come without a pretty drastic increase in money supply, or M2.
And
so this is,
oh no, Itai, just let me know when you're done with the slide. Don't go on to the next one, but keep going.
sounds good. So M2 money supply, here you have the US, here you have the European Union, and you have the entire developed world in green. And you know, the US has almost expanded the money supply by 30% over the past year, which is truly stunning.
Great, cool. Going in, before we get into the next slide, I'm going to ask a question, which we're going to cover right next, which is, at its peak, what percentage of US GDP was fiscal? That means government stimulus payments. So we're going to cover this in the next slide real quick. So just want you all to take a quick vote. Got a few for 20%, some for 15. We're going to take about another 15 seconds. Itai, do you think the audience is heading in the right direction or the wrong direction on this one?
I'm not sure what the vote is. Where do you think we are?
I guess we're going to find out in 3, 2, 1. So I think the questions aren't that good today because I'm guessing that they got it right. 20% peak US GDP was from fiscal stimulus. Is this the case?
I think we're actually closer to 15% of GDP.
All right. All right. So you're saying we actually stumped the audience this time.
It's not the largest number always. But what's interesting is, of course, you know, the US has run the largest fiscal stimulus or spending relative to GDP since World War II at 15%. So this is now causing a lot of debate about inflation. We've covered it quite a bit over our last calls. And the debate is, are we going to see inflation or not in the long run? So right now we're seeing, oh, I think someone is sharing the screen. Someone else.
All right, hold on. I'm going to put it only as a host real quick. And then I'm going to make you the host really fast, okay?
There's always a first.
That actually was a first, but that was a good catch. So everybody, whoever's screen we're on, we saw all your emails and we are now hacking you. I'm just kidding about that. We're not doing that.
All right, so we're talking about inflation, and you know, we are seeing some signs of inflation. So we're seeing shipping costs. That was to be expected because economies are opening around the world. And because they are opening around the world, everybody wants resources at the same time. So that's causing some shipping inflation, but that could very well be temporary. But at the same time, we're seeing wage inflation picking back up, both for manufacturing as well as the service industry. And I don't know if anybody here is hiring, but we're hearing a lot of reports of hiring being very, very competitive and qualified skilled labor being hard to come by.
I can say that I've been hearing that it's definitely been hard as well to hire. I think for everybody else, I know we got a bunch of business owners in here and entrepreneurs. You could just say yes or no. Are you seeing it harder to hire than before?
100%. Yeah.
Okay, so we have one right there.
Yeah.
Yes. Ooh, that was a resounding. It came in capital letters. Okay, so we've got about 3. Anybody saying no? It's pretty easy. Okay, so I think the response is a resounding yes.
Right, and
a couple. Oh, I was going to add one data point, which is all the talent agencies that we've been talking to have said they've never seen anything like this in their entire career. So the folks who are literally whose business is recruiting and hiring, that's the word on the street.
Good to know, and it follows a lot of the economic data we're seeing. So when you're seeing here, essentially inflation expectations are back to 2012, 2013 levels, but that doesn't tell the true story. They're actually above the Fed's 2% mark, but the Fed has made it clear that they're not necessarily going to raise rates right away. They're going to let inflation run hot for a little bit. So why is this so important? And we know wage inflation is a key driver in actual inflation, is because since 1983, so this chart starts in 1873, it's going a long time, going all the way to the current time. And this analyzes the different inflation regimes we've been in. There's actually been 4. The entire existence of the 60-40 portfolio is predicated on the period between 1983 and 2020. That's the only thing we know in recent history. Why? Because that was a period where the 10-year treasury peaked at about 15% in 1982, and it's slowly been going down. It wasn't like a big shock event until right now we're at about the zero bound on interest rates. And we'll talk more about that. But generally speaking, there has been 4 different periods. There's inflation, there is reflation after some periods of potential deflation, there is high inflationary periods, and there's of course the disinflation, and some economists like to call it the Goldilocks scenario. And it's really important because different asset classes tend to do very, very different. They perform very, very different depending on the type of environments you are in. It's interesting to note in this period, that was the period of famous panics and things like that. And the markets being really, really like volatile between deflation and inflation. And eventually the Fed was introduced in 1913 to solve this problem and control the money supply. And they did actually do that. If you're looking at it in that lens, things have been far more stable since the Fed was introduced in 1913. And this period in the 1970s, it's basically after we dropped off the gold standard in 1971, there was a period of inflation, but eventually interest rates went up and things calmed down. So it's really important to know what regime we're in, and it's important to know, are we going to be able to stay in that regime? So this period, the Great Moderation, the Goldilocks period, is a period where inflation is not a problem, but at the same time, so you have declining CPIs, but prices are very stable. Equities tend to do the best in this period, and they have since the 1980s. Treasuries do good as well. So this period is literally why we think the 60-40 portfolio is the way to go, because they counter each other, they're not correlated, but at the same time, they both rise over a long period of time. That's literally what we've had since the 1980s. In period of high inflation, though, the 60-40 portfolio doesn't perform well, where equities and treasuries sell off, and gold by far has been the best performing asset during those periods. In a rising CPI reflation period, gold and equities perform well. And during a deflationary period, only treasuries have performed well, with all other asset classes suffering. So I'll stop right there if there are any questions, because that was a really, I think it was a pretty informative slide.
Well, have you ever heard of the permanent portfolio, Itai?
Yes.
So the permanent portfolio is kind of based on this concept, right? But there he makes the 4 quadrants as bull versus bear, and then inflationary versus deflationary as kind of like the 4 quadrants that you're in. Does this map to that, or is that, because this feels like it's mapping instead to inflation and CPI as like the 2 quadrants instead?
Yeah, it literally looks at inflation alone, because the idea is that inflation kind of controls what asset prices do, because it's a matter of whether or not you have more or less liquidity in the economy, and comes out of the assumption that liquidity drives everything.
Okay, and then the second question is, given that there's been this is all based on historical data, but we've seen like new emerging asset classes that don't have a lot of historical data mapped to them. Where do you map certain alternatives, things like venture or crypto or even PE, things of that nature? How do you feel they map to these quadrants?
So I think venture and PE would fit under equities, because they could be private equities too. And in a period of deflation and liquidity being drained out of the system, it's hard to think that public equities would do well and PE would not do well. But it depends on the industry. There are some counter-cyclical industries. One of the benefits of actually being able to do PE is being able to engage in something that's counter-cyclical. But broadly, PE would probably be fitting with equities. Things like crypto, I think it's just too early to say whether crypto is going to be more like gold, or is it going to be more like equities? We just don't know. This is a very long perspective. We're looking at things from 1870s.
I think, Itai, the question I'd have, gold kind of represented is the broad commodity space. And so just gold.
Yeah. Commodities have both qualities. They can sometimes be counter and sometimes reverse. But during high inflation, commodities for sure do very, very well.
What about, where would you put in real estate in this?
Great question. Real estate's a mix of equity and gold.
Okay, so potentially a good potentially a good hedge in one of those heavy inflationary environments.
Historically, it's been a great hedge during high inflation, but it also does well. So actually, real estate would do well in these three categories, here, here, and here, and will only not do so well in deflation.
Got it. So that's a great question, Itai, which is, how does it all end? And that includes a poll, everybody. So this is a question to everybody watching right now. Is this going to end in hyperinflation, deflation, or inflation? Let's take the next 30 seconds.
What about stagflation?
It wasn't an option for today. So maybe a good one that we can add for the next time, but just because we've got these options, we're going to roll with it. So it looks like a runaway for inflation. Hyperinflation is making, oh boy, nobody's thinking that this ends in deflation. So I'm going to end the poll and I'm going to share it real quick. End poll, share results. Can you all see the results real quick? Thumbs up if you can. Okay, Itai, everybody thinks it's going to end in inflation. What do you think about what they have to say?
I think it's highly likely, but the question is, what kind of inflation, right? That's one of the key concepts. So what is the real cause for wage inflation? Because now we know wage inflation is a really big potential driver of actual inflation. So the US economy is in a very weird spot, right? On one hand, we have millions of workers that lost their jobs and they're not going back into the labor force. We see that in the data. But on the other hand, we're seeing that there's massive amounts of jobs opening, and it's one of the most competitive jobs markets out there. So how do we explain that? So here's the participation in the labor force data, and it has been declining for a while, primarily because of demographics. We talked about that extensively, so I won't go into that. But you can think of the boomers retiring, and there's just less people in the labor force. And here's COVID, this massive shock and huge drop in participation in the labor force. A lot of things have been reopened. There's a ton of jobs available. Why aren't people back to pre-COVID levels? You can see that here, total job openings being really, really high. But again, labor force has not returned. So I think what's interesting right now is that we have trillions in stimulus that are somewhat distorting the natural incentives to go back to work, especially in some of the lower paid jobs. In a way, you can look at it as potentially the largest experiment in UBI that's under the radar. I may take a lot of heat for saying that because I know a lot of people are in favor of that. But we are seeing evidence that small businesses are hit the hardest. So when you're looking at some of the surveys from the National Federation of Independent Businesses, they've actually reported that they're having 42% of jobs they can't fill versus an average of 22. But what's really crazy is 91% said they had few or no qualified applicants for job openings in 3 months right now, which is pretty wild. But it's not too crazy when you realize that 27% of total income is now transfers from the federal government, given this very, very large amount of stimulus that's coming in. And here is that survey of small businesses, literally at a record high, telling you that they're having a very, very hard time filling job openings.
Itai, do you want to go back to that slide for 1 second? Because I think what I wonder about is
this one?
This one. Going forward, what percentage of total transfers do we expect to be recurring, right? We have some of these one-off stimulus packages, but what percentage of this can we say, hey, going forward between unemployment, Social Security, you name it, you can expect about this percentage going forward?
I think the major problem is not the one-time $1,400 stimulus and stuff like that. I think it's more about I think $500 of unemployment benefits and things like that. So imagine somebody making maybe $2,500 in some place in secondary or tertiary cities, and then a job would be paying them $2,200 a month, one of the lower paying jobs, and essentially they have no incentive to stop collecting unemployment benefits and go work, which a lot of these small businesses that need the lower paying workers are really, really struggling with because of that reality. I've even heard McDonald's paying some areas people $50 just to show up to a job interview.
I'm seeing that. I do stand-up comedy, so I'm with a lot of younger guys, and they're living off the system and selling weed and smoking weed. They're living the life like they're in Panama or something. a lot of them don't have motivation just because what they can get, just free. Why work when you can almost make the same because of the government largest.
Which brings up a good point, Itai. If you get tired of me and want to let me go from my current job, I can just fall back on some extra government payments. So it's a perfect time.
It is a perfect time. It's never been higher. So yeah, I mean, we are seeing a lot of that happening. So the question for inflation is, when the Fed actually prints a little bit less money and funds the government a little bit less, which could happen when things normalize, some of these benefits go away, or some of it goes away. There will be more supply entering the labor force and maybe a little bit easier to hire. So that's definitely something to consider of why the current situation is the way it is. So those trillions of dollars in stimulus are coming at a price. We know about the increasing debt, the growth of money supply, and higher taxes. So here's that money supply against illustrated as a rate of change versus what happened previously. Crazy, almost 40% increase over that past year. And now things are going at a more normal pace of just 5 to 10% per year, where things have been growing pretty consistently between 3 and 5% during the past decade, but this is definitely sticks out as pretty massive. So let's talk about the taxes. Who's going to benefit? Who's not going to benefit? So the Biden tax plan, based on Goldman, is actually expected to reduce earnings per share in the entire S&P 500 by about 9%. We all know that's potentially coming. Here's how they look into it. And they believe it's not going to be fully implemented. There will be a variation of it. But if it was to be fully implemented, it will be a pretty large drop in EPS given very high valuation levels. And this is essentially who's going to be the biggest hit: communication, information technology, some in healthcare. The funny thing, the majority of it doesn't necessarily come from raising the corporate tax. It comes from the GILTI tax.
And I will tell you what the GILTI tax is. So think about your companies that are moving property rights elsewhere, right? This might be a tech company moving some IP to Ireland, and they have to pay a one-time tax. Okay, so these are the types of companies that are going to be, taking assets offshore that they want to impose a one-time tax on.
Correct. So it seems that equities are actually not pricing that in at all. So when you're looking at a basket of the high tax versus low tax stocks, the higher tax stocks had a massive rally given the Trump tax cuts just about here. And ever since pretty much leveled off, sold off a little bit. But even with everything that's going on, they have seemed to have not priced in on a relative basis the possibility of higher taxes. At the same time, you could say, well, they just don't believe it will pass Senate or the House, but it seems that infrastructure stocks have in fact outperformed because they are suggesting that policy will be able to pass something on infrastructure. So we can see here essentially the performance of the broad material sector versus just the infrastructure stock. So you got to ask yourself, well, they're pricing in higher spending on infrastructure, but not higher taxes. So that's something interesting to note. And for anybody that's interested, which stocks in the S&P 500 would likely be the most impacted by the GILTI tax, here is the list. I'll let you have a few seconds to look.
So I'm going to just point out what I see first and foremost. The company that's sixth most impacted by this is Apple, and Apple's market cap by itself is probably the sum of every other one of the companies on here. So it almost looks like this is potentially a direct attack on Apple. And if we think about the fact that Apple makes up such a large piece of the market cap, that could be felt across the board in everybody's portfolios. Potentially,
yes. Unless, of course, they grow themselves out of it and produce even more earnings, but it definitely is not. It's definitely less favorable tax climate for them.
So the Las Vegas Sands Company, didn't they sell like a lot of their holdings in Vegas, and they're pushing most of their business into Asia?
Yes, that's why they're going to be susceptible to the GILTI tax.
Sounds like maybe doing business in Panama doesn't sound as good as it does now.
Well said. Well said. Cool.
So what's interesting to me, and I find it almost entertaining. So I look into the Treasury data, and I'm not even fazed anymore by the fact that receipts are year to date for 2021. Of course, receipts are 1.7 trillion. Spending is almost 3.4 trillion. That's totally normal now. What's interesting is look here at what income corporate tax really is out of the sum total of spending. It's just 104 billion. Increasing that from 21 to 28% and collecting a little bit more in taxes does almost nothing to truly reduce the deficit. And that's just interesting.
Itai, I want to just back up for 1 second. The GILTI tax is not yet passed, right? It still has to face a supermajority in Congress.
Well, not necessarily, because see, Congress has the process called reconciliation, so they can push through, I think, like 1 to 2 bills that are related to budgets and taxes per year, and they don't need the filibuster, so they can pass through the filibuster. So there's a possibility.
So let's just back up. Has it been passed? Yes or no?
No.
Okay, got it. What needs to happen for it to pass?
They either need to pass it through reconciliation or through a majority.
And do we know when it's going to be going to vote?
No.
Okay,
But in the next, but the plan is the next few months.
Okay, thanks, man.
Okay, so I just want to point out something that I found very, very interesting going back into our, inflation debate or deflation debate. And John Maynard Keynes, which you could potentially say that he's the father of all this great monetary experiment. He actually said in 1936 in the General Theory, he said, there is a possibility, and I'll quote, that after the rate of interest has fallen to a certain level, liquidity preference may become virtually obsolete in the sense that almost everyone prefers cash to holding debt, which yields so low a rate of interest. In this event, the monetary authority would have lost effective control over the rate of interest. But while this limiting case might be particularly important in the future, I don't know of any example of it, right? And basically that liquidity trap is this idea, and I'll go into the real definition. People are really indifferent between bonds and cash because the rate of interest between the two is so minimal that holding the two is almost the same thing. So imagine a CD pays you 0.5% and cash is 0. You almost don't care about holding any debt instrument, or you don't necessarily want to invest your money away, especially if you're a corporation, because it means almost nothing for you to do that. And if that happens, the central bank kind of loses what it can do because rates are at 0. You can't lower it even more, and doing more stimulus kind of loses its effect because even if you create more money, that money is just going to sit in the bank. So I'm wondering,
real quick, what are the implications of what you just said, and why do you? I know for you, you think it's something really, really big. Why do you feel this is so important?
Yeah, so it's really, really important because we all assume that all this money printing is going to result in like massive amounts of inflation, but the reality is we have to ask ourselves, like, how much of that money actually ends up in the system, right? We know it ends up in the stock market somewhere. We've seen the correlation to the Fed's balance sheet with the S&P 500. We've seen, it's easier to get loans, etc. But how much of this like printed dollars ends up in the actual economy is up to debate. And by actually looking at it, I think we can figure it out. So if we are in fact facing a liquidity trap situation, like Keynes described in 1936, then it's potentially a huge problem for central banks because they don't really have as much power as they think. Putting rates at 0 doesn't really have any more impact, and even printing more money doesn't really work as much as it used to. So they may not have as much options as they think they do. And that's a big deal.
Okay, and let's see the data behind it.
So JP Morgan, they grew their deposits by 24% in the last quarter, but their loans actually dropped by 4%. And you can actually see this chart going back to 2000, the amount of deposits in red and the amounts of new loans in green. Now, the typical theory of economics says that it's actually deposits create loans. So banks, because they do business, are just going to want to lend as much as possible. People will always want to borrow. Corporations will always want to borrow. So as a result, you're going to have those two match. And regulation in the past, the RRR, the required reserve ratio that banks have, actually tells them, hey, guess what? You have to keep 5% of your deposits in liquid cash, so there's no run in the bank or anything like that. And now there's absolutely, you can run in the bank as much as you want. It's almost, it's not an issue at all. It's actually kind of funny how that works. So when you're looking at the loan to deposit ratio, so this is a way of saying how much do they lend for the deposits that they have. So here in 05, during the last housing bubble, 05, 06, banks were actually pretty fragile situation because they lent over 90% of their deposits out. But today, only 44% of the deposits are lent out. So they're over 200% of loans. It's pretty wild. Never been that case in all of the history of banking.
Itai, I want to pause real quick. There's a few questions that have come through, and there's some graphs I want to look at too. The first is this due to lower demand for loans or banks being less willing to provide loans?
There's some elements of demand for loans. Demand for loans, I believe, has been fairly constant over the past 10 years. Banks are willing to, they stopped lending a little bit during COVID to see what's going on and what sensitivity there is. They've come back to it. So there is less ability to lend after Dodd-Frank and a lot of regulatory changes in 08, 09. So there's some of that, but generally speaking, there's just a lot more money out there. A lot more money out there.
That makes sense. Itai, one of the things too in the previous slide, it looks like there had been a correlation between the two lines, and then they kind of diverged really sharply. Can you zoom in on this maybe and talk me through?
And I will show this.
I
will actually show this in more here.
If you have another graph already, go to that.
Yeah. So this is actually not just JP Morgan. This is an aggregation of the big four. So JP Morgan, Bank of America, Citi, and Wells Fargo. And here are the deposits in green, now totaling about $7 trillion in cash. And here's the loans actually has dropped to about $3.5 trillion. But what's interesting is, where do they start diverging? They start diverging after the global financial crisis, coincidentally, when the Fed starts QE programs and zero interest rate policies. And when do they really accelerate? It's COVID. We introduced almost 30% more M2 money supply into the system with QE programs and monetization of debt. A lot of it ends up on the bank's balance sheet.
Okay, so if I'm looking at this correctly, I'm saying that there's more money in the system, but I'm not making more loans. What does this mean for the business model of a bank?
It means that it's more and more difficult for them. So we talked about this extensively over the last few calls. JP Morgan, in their December quarterly call, they were saying, well, we are thinking about potentially charging a negative interest rate because we just have too much money on our balance sheet. They actually had a spectacular quarter, so I don't think they're going to do it, but the revenue didn't come from lending. We'll talk about where it did come from in a bit.
Also, one more thing too, and I apologize for asking so much. Didn't it used to be that the amount of money in the system was actually created by the banks in the fractional banking reserve, like the fractional banking system? And now it's like diverged. Like, can you walk me through kind of how money used to be created and how it's created now?
Yeah, so it's not necessarily about that. It's more about money is, in the classical sense, when the economy prospers and more money is organically created, because the money goes into deposits, then banks lend it out, the fractional banking system. And then as a result, let's say one guy's having a really good year because his business is thriving. He made $300,000. He puts it in the bank. Interest rates were 5%. So it yields him something. He's happy about it. He's happy about keeping his money in the bank. And then the bank is very happy to lend it out at maybe 7 or 8%. And then as a result, lending it out to a business that is now going to go out and do other things. So those same dollars keep circulating in the system, creating more and more dollars. And the banks actually are the keepers of the money. The more they lend, the more liquidity there is in the economy. The less they lend, the economy contracts. Hence the debt cycle that goes on. So when things are good, they lend more. When things are bad, they lend less. So the Fed says, hey, we're going to come in, and if things are bad, we're just going to flood it with money, and then the banks are going to lend. But that doesn't necessarily happen, as we see here in the data.
They're not. But couldn't we have just looked at Japan and said, hey, here's a prime example of what happened? Did this liquidity trap happen there?
I don't think it happened to that same extent. Yes, there is some evidence of that happening, but a lot of people said, well, Japan is not a good example, and there's other things that are going on in Japan. They don't have immigration, their demographics. Not that the demographics of the Western world is not that good too, but there is definitely an argument to say that the world is following Japan's footsteps. That's definitely possible. So now there are far more deposits than there are loans in the entire U.S. banking system. This is, again, totally unprecedented. Very, very little media coverage, if any, to that. And I think that's a really big problem because, again, in classical economics, loans always come first, and then banks receive deposits and care about deposits. They want to lend. So the question is, who creates the money in the system? Is it really the Fed, or is it the banking system? Because if the banking system doesn't lend it out, it's what Keynes said, that's the liquidity trap. And I think we're seeing real evidence that this is the status of the world. He predicted that almost 100 years ago, that could happen if we go through the zero bounds and stay there for a long time and print a ton of money. It will stop having an effect because it won't actually go into the system and stay in the banking system. So I think this is a really big deal. And I think we're seeing real evidence of that happening. That's another way of looking at it. You can see those big four banks, and this is just the delta between what they lend and what they hoard. So you see before the financial crisis in QE, there was a balance. Sometimes they were at a deficit and back and forth. And then they continuously just had a glut of cash on their balance sheet that they're just not lending. Here's another way to look at it. Here is the growth in deposits in red, and in blue is the lending that they do. And there is a $2.5 trillion delta between the two today that has just grown exponentially. This is actually even from before this chart appeared, I think in 2014 even, and just grew over time. So updated, I know we have explored this chart between the Fed's balance sheet, essentially how much the Fed is growing their QE program, and the S&P 500. I think the real correlation that's actually much tighter is between the excess deposits. So what delta you have between the loans you're making and the deposits you're having on your balance sheet and the Fed's balance sheet. It's almost like a perfect correlation, which explains why a lot of it ends up in the stock market and things like that as a derivative. People have access cash, corporations have access cash, they put in the stock market. It does not end up in the true system. And I think this chart is absolutely stunning.
This is great.
Itai, when the Fed stops pumping all this money, is that would be the telltale sign that this thing would fall apart?
Yeah, but here's the thing though, even if the Fed stops pumping, you could still see a ton of inflation later. Like imagine the lag effect if, let's say, interest rates went to like 3% and banks are sitting on this massive balance sheet, and then they're saying, now I can lend and make money on it, and I have this glut, and let's say there's more demand for loans, then you'll see inflation happening then. It could literally lag years, right? They may be waiting for a better lending environment to do that because they're just not making enough money out of lending. Maybe that's an hypothesis. So it's actually really, really weird, but that could happen.
I mean, I guess I would say, doesn't the Fed just, as you say, the modern monetary theory, just basically have no no couth to stop doing this? No, there's no reason. At what point would even the Fed go, okay, we need to stop doing this?
Yeah, it's a good question. I think it's when they see mainstream inflation and they get actually worried about it. But again, the situation here is, do they actually see it if the money is truly stuck in the bank? I think that's something to think about. So I I think this has a lot to explain why velocity of money is so low. So Jeremy, do you want to explain real quick what velocity of money is?
Yeah, absolutely. Velocity of money is just how often money recycles in an economy. So we can just think about, you provide a service to me, Itai, I pay you $100. Then with that service, you go buy gum, some other food, maybe a notebook, whatever, and then you pay somebody else, and then with that money, they circulate it and buy from another vendor. How many times that money circulates in the system is the velocity of money. And traditionally, the healthier an economy's been, the higher the velocity of money has been as well.
Exactly. So I think this explains why when we've pumped trillion and trillion and trillion into the reserve, the velocity of money keeps going lower, because essentially that money does not circulate. And the loan demand is just not nearly enough to offset the amount of money. At the end of the day, they can print as much money as they want, but it doesn't just end in the economy, it ends in the bank, in the fractional reserve system. Organic demand in the economy for loans is just not big enough in order to offset the excess amount of cash. So I think this is a good reason why the velocity of money has actually been collapsing. So not only that it's nowhere near those 08, 09 levels, but COVID totally collapsed it here. And we are actually approaching the theoretical floor of 1, where a dollar is just a dollar. So again, I go back to that example. I go to a restaurant, I pay the restaurant. The guy who owns the restaurant has my money. He obviously pays his bills with some, but it creates some excess income. He goes and spends it. That creates a virtuous cycle that goes through the economy. Where at our peak in the late 90s, $1 was actually almost $2.2 with all the amount of hands that it was changing and the virtuous cycle that it was creating. But we're almost at the point where a dollar is just a dollar.
And that is actually crazy.
That is crazy, right? It basically breaks away this entire like economic assumption of fractional reserve system, of fractional banking system, and how all this works. So a lot of these macroeconomics, that a lot of the theories that the Fed is running on are actually proving to not be correct.
Yeah. Itai, we have a few questions coming in. So is a currency even a currency if it's not flowing anymore?
That's a good question. I mean, I think anything is a currency if it has value and it could be a means of exchange. So, people are still going to use it. The only thing is, can you use it correct? Can you use it in order to do what you want to do as a policy tool? That's the bigger question.
Got it. And then just one other question that came in. Let's say hypothetically there were more loans that were out there that the banks were giving out, going back a few slides. Would that really even do anything to reduce the deposits in any way?
No, that they just issue a loan on the book. So imagine you have $1,000 to lend because you have $1,000 in deposit. You're hypothetically allowed to deposit to lend out $950. That's your theoretical maximum. So right now you're lending $500. So even if there was a new loan, you can still lend another $450. So they just don't lend as much as money as they have, because the Fed is giving them a ton of money. It ends up in their balance sheet. They just don't lend it.
Got it. Thank you.
No problem. So the banks, there's no new loans. What they do is maybe they just go on Reddit and they see what they can do in order to make more money. So what we're actually seeing is JP Morgan, Goldman reported this past week. They reported absolutely killer blockbuster trading revenue. Trading revenue for JP Morgan in just one quarter, up 25% year over year, 9 billion. Goldman Sachs really killed it, almost up 50%, 2 billion overestimation at 7.6 billion trading revenue. I think their trading revenue was 3 or 4x more than their wealth management business, and they're absolutely killing it with trading activity. So they don't necessarily even need to lend the money. But you got to ask yourself, is that the kind of behavior you want the banks to do and engage in?
I mean, I think it becomes just a matter of time before, some people make some bad trades, and then you have another Archegos type of collapse.
Yeah, I think that was a symptom. So, when we talked about Archegos last call, and we're like, this is the size. This is way bigger than LTCM. This is the biggest hedge fund bust in a way. Credit Suisse losing 5 billion, Morgan Stanley losing 8 billion, whatever, and the markets literally don't care. It's because we're not in the same situation. They're sitting on enormous amounts of cash, and their capitalization is vastly different. So there was no impact to the market because of that. You would need much bigger problems, but maybe you would need not just one fund speculating and blowing up. You would need a large domino effect of a lot of funds doing that. Okay, so how will velocity of money, how can it go up? How can this all change and all that in the banking system changes? So there's something really interesting that's going on in China. China is experimenting with a digital yuan, which you're seeing here is a digital yuan on someone's phone. They've done an experiment in October of 2020 where they dropped money into people's wallets in one area and see what they do with digital dollars. And that's really interesting to note. So I won't go too deep into this, but China would be the first digital yuan out there, token-based. So that's the equivalent of physical notes, but that are digital. And what's interesting here is that the digital yuan will have an expiration date. So one of the worries that when you do a money drop, essentially with helicopter money, the worry is, you give somebody a $1,400 stimulus check like the U.S. government just did. How do they know that people are not just going to save it for hard times, especially during hard economic times? People are likely going to save a lot of it if they are worried about the future. Imagine the $1,400 stimulus came in, and if you didn't spend it in 90 days, it would just be you just have to spend it or it's gone. So it will effectively stimulate the economy right when the policymakers want it to be stimulated. So that's a really, really interesting thing that's happening right now. I think, and by the way, if anybody is interested, we have done a really extensive 3-part call on the petrodollar and how it works. So this is an update on petrodollar.
And if you want to see the petrodollar series, just feel free to send a message real quick in the chat. You can just ping me directly and I'll make sure to email it to you.
Yeah, so the US issues dollars and more than 21,000 banks around the world needed to do business. So it gives the US the ability to freeze accounts in the entire global financial system. They call it the dollar weaponization. And a digital yuan would allow you to change money without the US knowledge, because a digital yuan exists outside of the SWIFT system, which is essentially the network that's used to transfer money between commercial banks. The US government can actually monitor. So even if banks move money to each other totally outside the US would have the ability to see that. So this is a way to move money around that's not crypto and is actually a digital version of the yuan. This is how it will work. A consumer wants and opens a wallet request. He does that at the bank, sends a verification request to the People's Bank of China. It's verified. A wallet's created. It could be Alipay or something that they already have. The yuan is dropped into the wallet. You can either use the wallet directly, exchange for cash, or deposit at a bank. It's pretty wild. So the question we all have to ask ourselves, given all these things between the glut that's currently in the balance sheets and all these other things, is will a digital dollar with an actual expiration date that is dropped by the government and monetized by the Fed actually break the downtrend in the velocity of money approaching one? Big question.
I get a question. How would they even know?
How would they know that it's happening?
I don't know. Yeah, I guess so. Yes.
I think it would probably be announced. We have a digital dollar. You can imagine this last stimulus was the same thing, $1,400, but instead of just sending a check, it will be into a wallet or an app that you literally have to spend in 60 days. That would create a lot of short-term inflation in the system.
That would be very interesting.
I think that is definitely where the future is heading. Okay, any questions before we hit some bonus charts?
Show us what's happening with insiders.
Okay, I will have to say in full disclosure, no recommendation to act on any of these. This is not a recommendation on any security whatsoever, just some interesting things that are happening in the market that we're observing and we want to share with the community. So
Perfect.
stock insider activity. Insiders in companies in the S&P 500, think of CEOs, CFOs, CIOs, everybody with a C in front of them. They have to report their transactions to the SEC. They tend to know very well about their own company and what's going on. It could just be that stock market is high and they want to take some profits. This is a smooth 12-month activity of what they're doing in dark red. S&P 500 here is in blue. In light red, this is their 3-month ratio. The 3-month ratio has gone sky high, as so have this. In the past, sometimes this was a good indication of some kind of top in the market, but it could also be, in this case, that they just felt the market's high and they want to take advantage of some profit.
Can it also be the case where their equity in the company has grown so much that they're having to liquidate stock just simply because their percentage of ownership's going up?
Totally. Yeah, that could be a case as well.
Could be regulatory forced.
Could be regulatory force. Nonetheless, historically, it was very rare when the market has dropped when insiders were buying. So that's a good thing to indicate to look at. With selling is a little bit more difficult. Another thing that's interesting, China, the Chinese stock market has diverged quite a bit from the S&P 500. We've actually seen that happen over the last 3 large market pullbacks, both in 2018, COVID. What's going to happen now remains to be seen. Another thing that's interesting to note, the ratio between gold and copper. This goes back here into the 90s. So we know copper is an industrial metal used in industrial use, and gold is used for hedge and used a lot for security. So when copper outperforms gold quite a bit, that could be seen as a sign of complacency in the market because everybody's chasing hot assets and not looking to hedge anything. And when everybody's crowding into gold and copper is heavily oversold, like we've seen in March of 2020, it can act as a good buy indicator. Again, not a recommendation, but a ratio to watch, and a ratio you can actually trade as well. You can potentially buy copper and sell gold, or buy gold and sell copper against it and trade the ratio. Lastly, here is Bitcoin funds versus gold ETF flows. Kind of interesting. Gold has not done so well, and it almost seems as if a lot of money from gold probably ended up in Bitcoin. That's just something I found to be really, really interesting. That's it for today. Any questions?
You closed hot right there, man. Oh, so here's an interesting one. Regarding the digital yuan, do you think people would try to take those assets to convert to a currency with a burn date, to assets they can hold? So I think he's trying to say, are they just going to take that and buy something with like an actual asset that'll produce money in the long run?
Yeah, I think that what they're thinking is, small amounts of money that you just have to spend before the expiration date. I think with the bigger stimulus, they're not going to drop it directly to consumers. That will be, like in the form of QE. So it remains to be seen. All that is really, really new, and it's hard to tell how that's going to end up.
Cool. What other questions is on the minds of the audience? Feel free. This is a perfect time to ask.
Is the digital yuan just for Chinese citizens? I mean, is that what they're kind of trying to control mechanism?
Yeah, yeah. Not only that, but they are able to see everything you're doing. So they will have the most accurate consumption data ever recorded. They'll know what you're doing with it, where you're spending the money, and they see it as this is a perfect policy tool because we'll know exactly what to simulate, or they will be able to target specific areas. So let's say Shenzhen or something like that needs money because that's a failing area. Other areas are not. We'll just drop money in that area. So they're just trying to, make a super innovative monetary policy. It remains to be seen how successful that's going to be.
I mean, my understanding in having been to China now is that if you do anything, you have to have a phone, and that they trace a lot of stuff right now through the phone. So this is just an extension of what they're already doing.
Yeah, they started doing that with COVID as like a contact tracing kind of thing. But yeah, I mean, they will just know even more about their citizens.
Ite, is the velocity of money really that low? Because I thought economic activity was picking up, and you were kind of talking about loans at the same time, but velocity wouldn't have to involve loans at all. It just means transactions, right?
It just means transactions, and economic activity is picking up, but it's not impacting the velocity of money so far. So there's just way more money out there. So even if economic activity is picking up, you don't necessarily, if you had less money in the economy and economic activity would pick up, you would turn dollars more and create even more inflation. But I think velocity of money is related with loans, because if the banking system would lend out more of the money that's in there, you will have more liquidity in the economy. You'll have probably more of that. But I think that the difference is, I think the mainstream economy is lacking dollars, where the investing economy does not.
So what you're saying is economic activity is picking up, but in absolute terms, but as a percentage of the monetary base, it's small.
Correct. Just think about it this way. In last year alone, 30% of the entire monetary base was added into the system.
Okay.
Itai, the graph only went back to the 1970s, but have we ever had velocity of money be this low in recorded history?
That's as far back as the data from the St. Louis Fed lets me see. So I can't answer that question, just given the data.
Yeah.
I don't think they were counting that data before.
Yeah. One of the other questions too is about the historical relationship between M2 and inflation, and maybe you can explain why increases in money stack doesn't necessarily mean inflation across the board, and it goes to certain classes of assets.
Yeah, I mean, just very generally, classic theory of inflation is comprised of two things. It's the amount of money in circulation and the velocity of money in circulation. So historically, when you had inflation, you have two. You have both velocity picking up and you have more money in circulation, and everybody's chasing assets. Right now, we just have one of the two. So I think that's one of the reasons we haven't had real inflation for a long period of time, because of that. We actually did one of our calls over the past month. We specifically addressed that issue. So even those historical periods of hyperinflation in places like the Weimar Germany, things like that, one of the leading indicators to a period of inflation was that all of a sudden velocity of money picked up 30, 40, 50%. So right now we don't see that at all.
Great. Awesome. Okay. Are there any other questions before we end it here? I did
That's what Dr. Kevorkian said. So
that's true. I have one last question that came in, and we talked about the potential for negative interest rate on bank deposits. What do you think the potential is of this happening?
I think it's possible. Well, they had a really good quarter because of trading revenue, so they probably don't necessarily need that. But when they're sitting on a huge amount of cash and they don't lend as much, then it is possible, especially if the interest rate itself gets negative. What would incentivize the banks to lend more? Probably higher interest rates. They pay money on CDs and things like that sitting in there, and they would prefer to lend it out to make a bigger spread. So I think it would be, and I think it's highly unlikely given the debt.
I've got a question is, you know how we've had spikes in the overnight lending rate between banks, but with sitting on all these deposits, why would that be happening?
Yeah, because they need different regulatory reasons. You're talking about the LIBOR spread versus the overnight banking spread. We talked about this. So basically, they need some form of collateral in order to make these overnight lending rates. And they're all sitting on a ton of cash and they don't have enough collateral. This could be like short-term paper, treasury, securities, etc. So we've seen a bunch of weird things happening over the past few months. We've seen the lending rates between banks overnight being zero, which makes little sense because they can borrow from the Fed for zero as well. And we've also seen very short-term treasuries trade negative, actually trading like negative 0.5 basis points or something like that, because the demand was so high to buy them because they need to post collateral because of the more deposits they're sitting on. There's just a glut of cash. It's crazy.
Cool. Itai, I don't know if Udav is there, but I think he may have a question for you. If he's not, I'll ask it for him.
Hey, Itai, question for you. So the implications of the kind of Yuan issuance happening faster and concentrated in China rather than the United States, kind of curious what you think the implications are of the accelerated pace of this, as well as how can it impact the movement towards decentralized finance, and then how do investors prepare for this?
Really good question. And I think we should actually do one of our calls on DeFi and what that is. So I think a lot of investors out there are sitting and basically seeing the same things that we're seeing and analyzing the same things and saying the solution is not going to come from the government. The solution is going to come from something we're going to do, similar to how Bitcoin started. And there's essentially a big movement to build an entire financial system away from the traditional market in a decentralized way in which people control the interest rates and the amount of supply simply by supply and demand. I think it's fascinating and there's a ton of opportunities there, which should be the topic of an entire call in which we can dive into that and what that means and how you can use that as an alternative.
Thank you.
Awesome
Great.
question.
Thank you so much for coming in. We appreciate it. I will be sending out, I'll make sure to send out a copy of this along with a database of all of our calls going forward. I think we actually even may have a new YouTube channel. So some of you have been asking for the ability to pause and be able to go back to your recording. So I'll make sure that we at least send that your way so you can go get to this. And in the meantime, just have a wonderful evening.
Thank you, guys.
All right.
Good night.
Get back
Great.
safe.
Good night, everyone.